Hi, I'm Mike Collins. I'm the founder and CEO of Alumni Ventures. Today we're talking about one of the questions in our space that we hear a lot is, why does my financial advisor keep ignoring crypto and venture capital and alternative investments? And so I'm going to talk a little bit about that today, because I think you have to ultimately take control of your own finances, and it's worth a discussion. And I have a very strong point of view. So before we get into that, these are my opinions. This is about Alumni Ventures and our kind of view of the investing landscape. Obviously, we're speaking our own book a little bit about venture capital today. This is not an offer to buy or sell any securities, which would only be made pursuant to formal legal documents. So let's get into it. We're going to talk about Bitcoin. We're going to talk about alternatives, risk reward, where it could fit in a portfolio, and investing in the future. So just a little bit more about me. I grew up in the Midwest, came east to go to school, got married, raised a family, and stayed. Been in the space of venture capital, entrepreneurship, technology, really my entire career. Started Alumni Ventures a decade ago, really with a simple mission, which is to bring smart, simple venture capital portfolios, access the top tier deals to individuals. It's an industry that was really designed for huge family offices and institutions, but increasingly, I think it's really important that individuals look at this. So our company focuses on retail investors. We've raised coming up on $1.5 billion, 11,000 customers. We're one of the most active venture capital firms on the planet. We have 100 employees. About half of us are full-time venture capitalists in the venture hubs, and the other half are back office people. Our reputation is very good. We try to be very helpful to our portfolio company CEOs, usually by activating our community and network for people, for introductions, for putting them in touch with resources that can help them build their business. As a co-investor, our job is different than a lead investor, but we try to be best of class in that niche. And who are the lead investors we co-invest with? So we come in side by side to some of the top venture capital firms in the country. Most venture deals, most CEOs put together a group. We take a small piece of that syndicate, usually with firms like these listed here as the lead investor, who's going to take the big chunk, and then there'll be smaller pieces in a round of financing. So we try to be the most value-added non-lead investor. So we hear this all the time from our 11,000 investors. Hey, I'm doing this on my own because my financial advisor doesn't understand it, doesn't want to do it, approves of you guys, but basically has told me I'm on my own. So we think that is unfortunate. If you look at the past 10 years, the assets that have actually done best, this isn't a hot quarter, but literally over the last decade, both crypto, and just use Bitcoin as an example, and top tier venture capital they have been exceptional asset classes. So you have to ask yourself the question, is my financial advisor doing right by me if they're ignoring two of the most important, disruptive, and productive asset classes? Our answer is no. I think this was Warren Buffett or Charlie Munger basically said, show me an incentive structure and I'll show you behavior. So most financial advisors do not work for a fixed fee. They work on a percentage of AUM. And so their incentive is put people in relatively low risk, stable growth entities, and basically grow along for the ride as people's portfolio grows, their fees grow with frankly not a lot of work. And so you know, I talked to one RIA and his nightmare is that the phone rings. And so yeah, historically they've first of all, they've classified things as alternative to make it seem as something that shouldn't be considered. And they avoid kind of high growth, high risk sectors that are new and they don't understand. And most retail customers are kind of fine with that. And again, I want to be clear, we're not saying that venture capital or Bitcoin is appropriate for everyone, but it should be at least discussed as part of a diverse, well-diversified, comprehensive portfolio, along with equities, along with real estate, along with fixed income. But to ignore it or to say it's too risky, I think is a very simplistic analysis of the situation. We think the world is changing. You know, obviously we're trying to do our part to make venture capital less risky by offering large diversified portfolios where you co-invest alongside exceptional lead investors. I think, you know, the growth of Bitcoin ETFs, of eventually other forms of tools that make these things more accessible on traditional platforms, I think are really important. But it's coming. So there's multiple benefits of thinking about alternatives. One is returns. Two is diversification. You know, things go up, things go down, things change, things get disrupted. Your Kevlar vest is diversification. And so the ability to be in a variety of asset classes that are non-correlated is really important. One of the things that goes on here is human psychology, which tends to, you know, loss aversion, these kinds of things where, you know, humans are likely to buy high and sell low, right? Which is the exact opposite. So some of the fundamentals of diversification, working with top tier people, making more than you spend, investing on a time-based system where you're not kind of looking and day trading. These fundamentals are true and work, especially when you get the benefit of time and compounding. Our plea is to talk to your RIA about adding some more, some of the alternative asset classes to your portfolio. And again, we're talking about not a fad. We're talking about what's gone on in the last 10 years. And frankly, a lot of us think are going to be really important asset classes for the next 10 years. If you look at the amount of value created by companies before they go public, since when I started in the business, it has grown precipitously. Companies would go public at a $400 million valuation. Now you have companies, you know, raising money at $50 billion in the private market. And if you're only going to play when companies go public, you're missing out on really the economic engine of modern society. So again, good people wanting to do the best, but things change in the world, and a lack of expertise, things move quickly, much more volatility. There's regulatory uncertainty that has happened in some of these things over time, but I also think there's a pretty fundamental misjudgment between what clients want and their understanding, and we are seeing this also with a huge generational switch. You know, I was with a family who has done very well, and they were talking about a meeting they were having with their kids, and they were trying to introduce their kids to their financial advisor, and the kids basically said, you know, you pay 1% for them to put you in ETFs, and you're an idiot, mom. And, you know, when you die, no way we're working with Joe. So I know that's a little harsh, a little abrupt. That's how I guess adult kids talk to their parents, but I think we're going to see a fundamental shift. You know, this is an industry that is shrinking, young people not going into it. There's huge consolidation going on with financial advisors. I think many of them, again, are looking for tools, looking for ways to do this. I think it's going to be really driven by their customers demanding it, who are going to basically say, hey, do this with me or I'm going to go direct. Yeah, and I want to be clear, index funds belong in a well-diversified portfolio. The beauty of something like SPY or any kind of S&P or international index fund is a kind of rebalances toward things that are growing and more valuable. I think it's wonderful that there are now ETFs for Bitcoin, but I think, you know, if one wants to do the best they possibly can for their financial future, again, I think it's a lot like your healthcare. I think you need to own it. I don't think you want to delegate that to somebody else completely, and you want to really view it as a partnership and not here, take care of my money, here, take care of my health. Just tell me what I need to do. So again, you know, we talked a little bit about this. I think there's also, frankly, you know, again, I'm talking to my financial advisor friends at this point, which is, I think we have a duty, you have a duty to do the best by your clients, and to ignore these asset classes, I think is, you know, failing to do your job, to be candid about it. And so, you know, I do think this needs to come up in a conversation. I do think it needs to be actively considered. You know, obviously selling our own book when it comes to venture capital, but I would also argue the same thing is true for real estate, private equity. I think this is true for, you know, blockchain, Bitcoin in particular. I think it's the digital alternative to gold. I think it's disrupting gold as a repository of value. I think we're finding more and more companies, more and more family offices, more and more sophisticated people are putting this on their balance sheet at an appropriate allocation. And so again, that's not selling my own book, but I think it's the right thing to do. So I think there's a risk of, I think there are some risk of not doing it beyond just losing clients. So what can you do? One, I think there's great ways to get educated, to talk to people about it. Obviously, we're in a world of AI where everybody has incredible personal information through Gemini or ChatGPT or the like, to get educated, build expertise, build confidence. I think this is true for the individual. I think this is true for the RIA. in every facet of life. Work with people who know what they're talking about in these spaces. And then, go into it with the right attitude. I do think, like, how can we make this work? How do we start? What's the baby step to take? Not everything has to be all or nothing. So, but again, I think it starts with conversation and an open-mindedness to more broadly consider one's investing tools. Same thing really for the individuals. Take control, ask, work with people, get educated, work with your team. But sometimes you have to work around your team. I mean, there are, again, other facets of my life where it's like I've got my main person and then I've got my backup person, and that's true for, financial stuff, that's true for health stuff, that's true for, all the big pillars of what I try to accomplish professionally. So take control. We would like to be part of the conversation. We provide a lot of information about venture capital, how it works. We have strong opinions on the right way to do it. I think there's a lot of perceptions about venture capital that it is like risky. I think if you make 3 investments a year locally, yeah, I think that can be a high risk endeavor. But I think if you put together large, diversified portfolios, if you invest consistently year over year and get good diversification, work with good people, I think you're going to do really well in just about any asset class. So, if you're happy with your venture portfolio, that's great. But again, selling our own book here, we want to be your venture partner. And we work with a variety of different people, from people just figuring this stuff out. We call them the venture curious. But we also work with people that are kind of have made it and are now looking to pay it forward. We're looking for people that are looking for alpha and really looking for this part of their portfolio to swing for the fences and learn and have fun and be on the cutting edge and impact their own professional trajectory by being the person who knows about technology and what's new. So again, our plea is get educated, get on the phone with us. We want to be your venture partner. So we do have, I see we have questions, and so let me just, read a few of those. And what role does liquidity play in the hesitation to invest in Bitcoin or venture capital? And how can investors work around this limitation? That's a great question. So different asset classes have different characteristics, different strengths and weaknesses. Again, buying Bitcoin now doesn't have a liquidity issue. It has a volatility issue. So again, I think it's pretty easy to buy and sell that at this point. You have ETFs, you can kind of control that within pretty traditional mechanisms. VC is the nature of the beast, is it is a long-term illiquid asset class. Actually, as is real estate for the most part, that stickiness can be actually helpful because it kind of prohibits people from trading too much. And a lot of times that's not the way to go in investing. Is patience usually pays off versus trying to time market. So yeah, when you look at a portfolio and you decide how much am I going to put into public equities, fixed income, How much am I going to put into real estate, into Bitcoin, into other alternatives like venture capital? I think you want to consider, is this long-term capital? Is this, do I need access to this money to pay rent? You know, things that are on the illiquid side of the equation shouldn't be in that bucket. So allocate appropriately. You know, I would make the argument that public equity shouldn't be rent money either, because you don't want to be forced to sell when whatever the panic of the week happens to be, or the bubble of the week happens to be. So view this consistently, have discipline, you'll do well. If RIAs continue to ignore these kinds of asset classes, do you see the role evolving in wealth management? You know, could they become obsolete? Listen, I think it's a competitive business, and I think there's always generational changes. I think the next generation is going to inherit tens of trillions of dollars, and they grew up digital first, and have disintermediated a lot of things in their life from news. So I think that's going to continue. So I think, you know, there needs to be and AI is going to kind of accelerate, compound that. So I think developing really core relationships with customers are important, and there will be organizations and people who do that really well, and the rest will struggle. So yeah, I think it's lean in or you're out. The majority of my assets for long-term are held in retirement funds. Can retirement funds invest in VC and Bitcoin? Again, the answer is yes. There's a few steps. Again, hop on the call, but yeah, it tends to be a good match. You want to think about matching time horizon with different buckets. Like I mentioned before, if it's, you know, mortgage money, you want that available in cash. And if you're trying to compound over 10, 20, 30 years, that's when you look for tax advantage long-term assets. Do you think IRAs are shying away from offering these types of investments because of the compensation issue? Yes. Do you believe an IRA is following their fiduciary responsibility of not having a discussion with their clients around alternatives such as Bitcoin or VC? Yes. So again, as you can tell, I have a pretty strong point of view. This is just the way the world works. We work with some tremendous RIAs ourselves who are, you know, on the aggressive side, buying up other people. They view this asset class as strategic, important. They like offering things that other people don't. We like working with those RIAs. We also like when our customers bring their investment advisors to our discussions, kind of, you know, bring a +1 to learn about it. And yeah, I think we encourage people to talk to us. We have some of our funds here. Some of these are on the more high alpha, high risk, high return end of the spectrum. Others are really more of a kind of like our foundation fund is more of like our, hey, this is something new to me. I'm a little nervous about it. Where do I start? We designed our foundation fund to do that. Again, we have lots of materials. We're very transparent. We like talking to people. A well-informed person is our best customer. So, you know, we'd like to talk to you and help you with your educational journey. So appreciate everybody's time today. Innovation is really important. Technology is going to change the world over the next decade. We hope you want to join us and be part of that journey and lean in. So be well. Thanks.